And good afternoon, everyone. Thanks for joining us today. For those of you that are just tuning in for the first time, my name is Todd Jones. I'm the Director of Investments for Gratus Capital, and welcome to our Market Matters series. We're going to be about 30 minutes today, and we're going to follow the typical format, which goes like the following. We're going to touch on some COVID-19 updates and what's developing globally with that situation. We're then going to move to the economic and investment updates, of which there are quite a few to share with you since our last episode 2 weeks ago. And then we're going to talk about the special topic, which was deflation, what it is and why you should care. And again, we only are touching on these special topics from interest that you clients are asking us about. So we figured we'd spend some time on that and bring you up to speed on what we're thinking on the deflationary front. So let's get started. So this is the same time series as what we showed 2 weeks ago, and I think it's just good to present consistent or similar looking information. That way we've got a reference rate or a baseline. One troubling thing that maybe should be taken away from this chart is that the number of global cases is now rising again. Now, most of that has to do with infection rates spreading very rapidly through some emerging markets, as we touched on a couple of weeks ago. But also there are some incidences of a second wave or reinfection rates in areas like China and potentially in Korea, where that's starting to become a bit of a topic to touch on. But you can see really where most of the growth is coming from is in emerging markets and in Africa, particularly coming out of places like Brazil, which that infection rate doesn't show much way of slowing down here. Iran as well, on a reacceleration here. It's interesting that are basically having their second wave. And then places like Russia is hanging out with a high level of infection or new infections within that country. Now, interestingly, Russia just yesterday is claiming that they've got a solution for the disease that with one of the drugs that their drug companies has developed. We'll see what the WHO really says about that, but needless to say, most people are fairly suspect that they have the silver bullet. But again, I guess the key thing here is to look at emerging market containment, and that will be critical to thinking that we can all at some point move past this down the road. And then speaking to the second wave here, now that we've more or less passed the peak in the US, I mean, certainly there are some areas that are still experiencing varying levels of infection, some greater, some smaller. But the second wave really refers to, okay, now that we've got the initial wave under control, what happens when it comes back through? A lot of people are suggesting, or a lot of doctors are suggesting, that the time that would come back would be sometime when the weather gets a bit warmer. So summer and maybe late fall, I think, is when most epidemiologists are suggesting that might be the case. And the template for this, of course, is way back in 1918 with the Spanish flu outbreak. This is an actual picture from the parade that is said to have caused the second wave in the US. Now, the second wave was a lot less devastating than the first wave, but still, nonetheless, it did wreak havoc for a couple of months there. You can see on the parade day, this is actually a military parade in Philadelphia. I think it was actually what the celebration parade after winning World War I. It was on September 28th. By October 1st, every bed was filled in the hospitals in the Philadelphia area. City shut down shortly thereafter, and then you can see some of the death rates started to increase. So really have to be diligent about monitoring where infections could creep up. And of course, in light of what's going on from a civil unrest standpoint here in the US, a lot of epidemiologists are concerned that those types of situations, like what happened here in Atlanta, Los Angeles, and a number of other cities around the country, is actually a way that the second wave could potentially kick off, considering most people aren't wearing masks during those. So anyway, just something to keep in mind. We're monitoring, rates around and developments around the disease fairly closely, because that will have an impact as to how we think about the forward-looking prospects for the economy, particularly to open up fully. So let's look at some economic and investment updates. Here's our ranking system that we haven't changed in the last couple of weeks because there really haven't been a lot of investment-specific changes. And again, just to reiterate, the most recent changes we made within the portfolio or the investment committee rankings were upgrading developed international stocks from neutral to modestly attractive, and then upgrading real assets, things like pipelines, infrastructure, things of that nature, to a modestly attractive state. And so that's made their way into their portfolios in one way or another. And here are some portfolio notes I wanted to touch on. And again, there are some things we've done recently. So we started as I indicated in prior market matters, we had targeted the S&P level of around 3,000 to start rebalancing accounts again. So recall that, and I'll show you the year-to-date picture with arrows when we rebalanced, but we feel pretty good about rebalancing mid last week because the S&P hit our price target for that particular activity. And it's important because that activity has a meaningful impact on a number of things. One is that it helps control risk. So doing a rebalance allows us to increase our dry powder or our cash equivalents again. So recall that in March this year, we sold out of the ultra short bond ETF to add to equities because they were down roughly 30% at the time, and exited that position entirely. Now we've basically been able to fill that position back up, and what it does is it gives us optionality or opportunity cash to deploy when markets potentially go lower. Not that's necessarily going to happen, but gives us that optionality. Again, I think this year has been a great demonstration of active management and how that can really be additive to a portfolio, particularly in areas that are thought to have been really efficient. So for example, there's a number of strategies in our accounts that are beating their benchmark by high single digit numbers, even double digit in some cases. And I think that's only going to continue as we move through this particular challenging period for the markets. And again, part of that is just being diligent about knowing what you own, but also making changes when appropriate. So one of the more recent changes we did in conjunction with the rebalance was reducing our index growth equity exposure and replacing that with a active large cap mutual fund, growth mutual fund. So we feel really good about that change because, again, the reason to do that is because active management, I think, from this point forward, will be one of the few ways to make money if the market decides to get chopped sideways for the foreseeable future. We continue to high grade the portion of our bond portfolio. Again, this is where we're seeking income and capital preservation. So I think this is a real important thing to continue to do because spreads now, high yield bonds are trading at levels that are fairly close to where they were pre-crisis, and I think that should concern all of us because you need to maintain diligence, not just seeking out yield. And then finally, just a note here, we are raising capital for private market opportunities because we have seen a number pop up recently, particularly around some of the dislocations with the COVID-19 and what that means for what that's meant for capital markets. So whether it's buying secondary pieces or real estate at distressed prices, those are all opportunities that we're actively looking at right now. And then here's the chart that I just wanted to point out, shows you how active we've been on in the rebalancing front. So we always use the S&P as our guidepost, and we use price performance and or time to indicate when we might need to look at rebalancing again. Now, it's not a rote approach, and I'm actually putting out a publication either today or tomorrow that will speak to how we look at rebalancing and where the value is added. But I think it's important to just point out that we've been able to rebalance accounts twice in the last 3 months, and that makes a meaningful amount of difference in that it's really able to harvest the volatility that the equity markets are giving. It's one of the few ways you can do that. The other way would be active stock selection, which, as some of you may know, we also do. But the real reason to do this is because Vanguard did a great estimate on rebalancing, and Vanguard estimates that you can generate somewhere between 25 basis points and 50 basis points of extra return every year if you implement a rebalancing strategy. Now, there are some firms out there that rebalance too often, I think, that do it like once a month or once every few weeks, and I think that's way too often. But I think the way we've decided on doing it has been pretty additive in the current environment. Just a bit on the equity markets here. You can see pretty much equities as represented by the, or large cap equities, the S&P 500. This was through last Friday, down only about 5% for the year. That's pretty remarkable given where we were back in March. But still, the gap in performance continues to persist between some of those areas that you may recall we have very little exposure to, particularly small cap stocks here in the blue line. A reference index for that would be the Russell 2000, or emerging market stocks in the pink line. And we recently only upgraded the international developed stocks because of the valuation that they have relative to US, but still significantly overweight in all three of these categories. And that's certainly served us well, being in the largest US companies through this whole downturn. And we think that's probably likely going to be the allocation for the foreseeable future. One good thing to note is that in areas that we did message, I think it was in our quarterly market outlook back in September or October of last year, I touched on the idea that startup valuations were a little frothy, and that the collapse of the WeWork IPO was really instrumental in getting us feeling decent about the foreseeable future. And I think this just shows you exactly what I was referring to, and those trends have just continued downward. So what this shows you, this is a chart going back to 2008, the Bloomberg US Startup Barometer, and the way that is constructed is it's a composition or composite of valuations taken off private markets, where insiders can trade their shares, off market essentially. And what happened is, you can see starting in the middle of last year, valuations started to turn lower after a really parabolic rise coming into 2018. And then remember, that's when like the Ubers of the world decided to go public. But now they've come back to a level that more closely represents price performance of the NASDAQ 100, which, go figure, is really about the level that they should attain in any given year. So it's really good to see that. This excess up here is one reason why we didn't necessarily find private markets on the venture capital side very attractive. But needless to say, with this collapse in price, that at least for private market strategies might become more of an opportunity at some point here in the near future, particularly if COVID continues to impact the economy the way it has. So one thing I did want to touch on recently that has been starting to get some play in the media is this what they call a rotation between growth and value. And really, rotation, that's just an industry term that means, if you're long technology stocks or growth companies, you would be rotating from those companies into underperforming Russell 1000 value companies. And this is an interesting dynamic because recently it has started to shift a little bit. Starting, I think it was 2 weeks ago, value really started to, if you were to draw this line here on a relative performance, outperform growth for the first time I can remember in, it's got to be at least 18 months. But it's something needless to say, it's something we're watching very closely, because that also would have impact on how we should potentially position accounts on the equity side. Right now, growth versus value, we're pretty much equal weighted across most of our benchmark accounts and most of our strategies, so an equal split. But there may be an opportunity to pivot potentially at some point to value if growth valuations start to falter a little bit. So it's something we're watching really carefully, and it would be, the reason to watch it would be setting up like a situation like the 2000s, where you may recall early 2000s, where the technology companies of the Russell 1000 did very poorly, particularly the NASDAQ, did very poorly over 2000, 2001, and 2002, I think down something like greater than 55 or 60% in the NASDAQ 100, whereas the Russell 1000 Value Index was actually positive during those years. So we're certainly keeping an eye on these performance trends because it may lend some insight as to how and where we should be positioning. So keeping an eye on that. And then I just wanted to reiterate, with all the bad news with, and I showed this 2 weeks ago, but I'll show it again because it's still relevant. With all the bad news around what's going on with the riots and challenging economic conditions, I think the Federal Reserve is now, or Atlanta Fed is now expecting the U.S. economy to shrink at an annualized rate of 50%. It sounds like a scary number, but it's going to be roughly 1/4 of that growth rate or negative growth rate, followed by probably some recovery after that. But it's important to note that these periods of economic distress, where the times look the most challenging, actually produce some of the best returns in the future, and that's because people, generally speaking, or investors get very pessimistic around some of these pivot points. And you can see it come through, particularly, when unemployment rate is high. Well, that indicates that there might be some greener pastures ahead because that a more available labor pool, lower cost potentially, could lead to productivity gains. Real GDP, this is the one I was referring to about the economy contracting. When the economy looks the worst, at least in this series, at less than 1% or lower, gains have been the best in a forward-looking way. I think it's a 10-year forward-looking return. And then finally, what really matters, of course, is earnings in the S&P. And you can see when earnings are projected to be the lowest, the growth rate is projected to be the lowest, that's usually about the time when you're in the middle of a recession, and people get very cautious and look at what happens in the following 10 years. You get some of your best returns. So again, markets are a discounting mechanism. They look, and what that means is they look into the future. They look past the near term to the future. And right now, what the market is showing us or telling us is that the probability of investors, or the majority of investors, that the reopening is going to have some positive impact to earnings in the economy, which I think is part of the reason why the S&P is now, nearing 3,100 as opposed to 2,300 4 months ago. Fixed income, I just wanted to point this out. It's, again, a very tricky story. Yes, there has been some recovery in some of the tertiary markets within fixed income. As you may recall, we don't have any exposure to high yield or junk bonds or emerging market bonds, primarily just because in such a tenuous situation, we don't think the risk is worth the return. But, our exposure to aggregate bond index, investment grade, and even some asset-backed investment strategies like mortgage pools have held up just fine throughout all of this, generating income we're looking for while also preserving capital, not price appreciation, but preserving capital. And so we think we've done a pretty good job on that front. But, we don't own 100% government bonds, which is essentially what this red line is, the aggregate bond index. So, we're not necessarily getting much price appreciation out of bonds this year, which is fine from my perspective. So just some key takeaways before we get to the special topic would be that, sideways market would still be our best estimate. It takes time for some of these market cycles to unfold and develop. Retesting of the March low is still the base case, but that's getting less probable, of course, as more time is allowed. Building back up our portfolio resiliency is important right now because we want to be ready for any unforeseen risks or challenges or things like a second wave that might throw us back into a negative situation with the equity market. So we're actively buying umbrellas while it's not raining, just to use a phrase that I particularly like. And then we are watching this growth to value rotation pretty carefully because turning points are always very difficult to forecast. You don't want to make too large of pivots at any one period in time, but it's something we're watching because it could signal a paradigm shift for the growth domination of value that's occurred for the last 12 years or so. So with that, I'm going to turn over to here to touch on our special topic, which is the dreaded D word, deflation, and what it is and why you should care about it. Because I think there is really some misunderstanding about what deflation is. So, I thought this was a great topic to touch on, so I hope you find it interesting. So let's define what inflation is, and that is, according to a number of different sources, I know everyone could define things a little bit differently, but it just basically means the general decline in the price level of goods and services. So if you bought a gallon of milk this year for $4, next year it might be $3.75. That's deflation. Or if you buy a house for $400,000 and now it's worth $375 or $350, then that's examples of deflation. It's usually associated with the contraction in supply of money and credit, and what that means is money and credit just basically means that the banks pull back lending. So think about why the 1930s were so devastating in the Great Depression. Was because the banks, well, first of all, there was a number of banks that collapsed. I think it was about a quarter of all banks collapsed. That also wiped out savings of the consumers that had deposits in those banks. But also because of that, the economic conditions were so severe and negative because the asset bubble in the stock market popped. Banks got really gun shy about lending for any new business venture. So really, anything that really wasn't guaranteed to make money wasn't likely funded by the banks. Prices can also fall due to increased productivity or technological developments. That's what I would consider to be the good type of deflation, meaning if you're replacing workers with software that can do the job just as well, if not better, that's productivity enhancing to the owners of those companies, and those are just give them more available capital to reinvest in the business or start new ventures. That's usually the good type of deflation. And that's really what we've been experiencing with things like software costs over the last 10 years, or music's gone from I think when I was back in the 80s, it would cost like $20 for a CD. Now to download an album, it's $8 or something, or $9 on iTunes. Whether the economy, price level, money supply are deflating and inflating changes the appeal of different investment options. We'll actually talk about what is kind of the deflation playbook if that does rear its ugly head. And one way you can track it, or you usually understand whether or not you're in a inflationary or a deflationary environment, for better or worse, is to use the government's, U.S. government's Consumer Price Index, also known as the CPI. It's a monthly index. It's a basket of goods and services that the average American would use, and it captures everything from healthcare costs to gasoline costs to housing expenses, food and energy, things of that nature. So let's talk about why you should care. Well, there are some pretty poignant examples globally of deflation. I mean, the most recent example the U.S. had with deflation was in the 1920s and 30s, well, 30s, not 20s, where an asset bubble popped, meaning the stock market dropped roughly 80% from its peak to trough in 1930. And the byproduct of that was a severe downward impulse on demand from consumers, but also from businesses. But more recently, there are some examples out there that we could point to that would say, hey, we should pay attention to where we are in this inflationary or deflationary cycle to understand maybe where we should be positioning. This is something we talk about quite a bit within the investment team, investment committee. So obviously we're doing this on your behalf, but I thought it was good to explain some of what we're looking at. So this is the Japanese Consumer Price Index from 1990 to the year 2010. The whole series goes through 2020. But what you can see here is that for orientation purposes is the inflation rate, 0, 1, and 2 on the axis, all the way up to 3, then -1 and -2. And notice what's happening. I've drawn a red line to suggest that there was a severe negative force pulling inflation down in Japan between 1990 and 2010. And what was that force? Well, of course, it was the Japanese stock market that was, and property market that was all the rage in the late 80s and early 90s. I'm sure you recall the example of the Imperial Palace in Japan being worth more than the entire city of Manhattan. I mean, countless examples like that just are mind-boggling to think about. But when that asset bubble burst, it created a negative pulse of demand from consumers because they felt less wealthy. And this is what the Fed is really the Federal Reserve is trying to support, which is the wealth effect, meaning that if you own assets and those assets continue to go up, then you feel more inclined to spend and more inclined to take money out of savings and use it for a variety of purposes. But this is the exact opposite happened in Japan. You can see it went into a almost -2% deflation rate during the more recent GFC was negative at various points in the 90s and 2000s. And how did that manifest itself? Well, this is what I was referring to is the Japanese stock market, same exact time period, by the way. And this is the Japanese Nikkei 225. It's their S&P 500, if you will, in Japan. And the Nikkei in 1990 topped out around 37,500. And over time, getting all the way down to 2010, same exact time series went down to 10,000. And now that's 20 years of markets just going in one direction. That's a real punishing situation for investors because the general trend of the market does have a big influence on people's feeling about how much they want to spend and various activities. And you may remember that in Japan they have a very high savings rate. Well, also I'm sure many of us know my grandparents were certainly very big savers. Deflation creates a lot of savings, and you can see that coming through, and why we need to pay attention to it here in the U.S. because the savings rate in the U.S. I showed the team the chart of the savings rate in the U.S. and for May, the savings rate was the highest it's ever been in the U.S. It was at 33%. The average savings rate in the U.S. is somewhere in the neighborhood of 5 to 7. So, what that tells you is that people are getting much more cautious with their spending patterns and activities, and that certainly makes a lot of sense. But when people save and don't spend, that just exacerbates the downward spiral for the economy, and then by extension, the stock market. So something that I think it bears mention. Not that we're in that situation here in the U.S. quite yet. There's still quite a ways to go, as I'll touch on later, but something to keep an eye on. And believe it or not, this is much more frequent than you might think if you just look globally. So another example that you may recall would be what happened to the Greek stock market. Remember when Greece needed the bailout from the European Union and the IMF, they were forced to restructure their debts, restructure their pension and benefit obligations. And that effort to right-size wages and also pension benefits had a substantial impact on demand from the consumer side because it was effectively cutting a lot of the income people were relying on to buy goods and services. And you can see similar situation. I don't have the inflation numbers here, but it definitely is very hard to get Greek inflation numbers. But it was, from what I've seen from the IMF numbers, it was very similar to the Japanese situation where they went into a prolonged period of deflation and prices, which by extension caused a roughly 75% drop in their stock market from 2014 down to 2016. So that's a more recent example. And then, of course, there's the old Irish stock market, which this is the Dow Jones Ireland index. So it's a composite index, just like our Dow Jones. It's similar in nature. And they took the hard medicine during the financial crisis as well, similar situation, going from 650 in the start of 2007 roughly down to below 150 in 2009, representing about an 80% move lower from 2007 to 2009. Having relatives that still live there during that time, and I visited during 2010, I can tell you that the prices in their property market also collapsed because of prior to 2008 and 7, what was happening was because Ireland, it was called the Celtic Tiger phenomenon, and a lot of cheap labor came in from Poland and new European Union member states. A lot of capital from outside the country came in to buy property, and then of course when prices started to move lower, all the buying activity froze, and that created a deflationary impulse. So now, how does this manifest itself? This is that deflationary spiral on the next slide that I wanted to just point you to. So if prices or an asset bubble pops, or like a stock market declines substantially, or a property market declines substantially, it creates a negative impulse to demand for those owners of that real estate or stocks or assets in general. That negative demand results in falling prices because people are restraining spending. And you can even see it now. I mean, some of the food delivery services like Uber Eats or Postmates or whatever are actually subsidizing the price of deliveries to get more demand into their system. I've seen it a number of times personally. And that's results in falling prices, but it also isn't good for the business owner either. Then what happens is when prices fall, then you've got a situation where your equity evaporates potentially, where you get debt defaults. When people default on debt, they go into bankruptcy and workout situations. And then of course, when you're in bankruptcy, companies tend to lay off lots of workers, as is starting to happen in Silicon Valley right now because they're not profitable, which also results in wage reductions generally across the cohort. So I guess my one summary here is, not to be too negative here, that we're still quite a ways off from outright global deflation. I do think we're going to see, just prepping everybody, I do think we're going to see some negative CPI or consumer price index numbers later this summer, potentially. And that shouldn't necessarily scare us too much because we have quite a bit of offsetting capital in being infused into the economy from the CARES Act 1, potentially CARES Act 2, the HEROES Act, all totaling roughly, I think it's going to be somewhere between $8 to $10 trillion before it's all said and done. That will play a key role in stabilizing the deflationary impulse. And then the question, of course, becomes, with all this money circulating in the system, should we worry about inflation? And what I always think is inflation always comes later than you think it will, but when it comes, it's gonna be pretty rapid. Our best forecast that we run through as a team would be that inflation is likely not to come to the United States sometime into the next 3 or 4 years. And at some point, we will get inflation, but I think that all the central banks are being very careful not to create that. One area that we would be looking at very closely to know whether inflation is coming, this just gives you an eye into our process, is to look at what the US dollar does versus major trading partners. Again, like versus the euro or the British pound or the Japanese yen. Again, we're doing that as an investment team. We're not expecting you to do that personally, but that's just an area that we're looking at, because if the dollar starts to fall, that means confidence is being lost in the dollar as the reserve currency, and then we've got a bigger problem with financing our debts. And then just to give you an idea of like the playbook for if deflation were to hit the US, and we saw that coming, what you would likely want to do, and what's worked in prior periods, would be adding to not only intermediate but long-term bonds. And the reason you do that is because if you expect the economy to contract, then that just means lower interest rates because of the way that interest rates are calculated on government bonds, because it's an inflation premium plus a credit premium. Cash is also a viable option in this environment because cash today is going to be potentially worth more tomorrow, given your purchasing power is rising. Alternative strategies. There's been a number of stories I've read recently about very successful traders during the depression of the 1930s, and the way some of those traders really survived during that time period, even thrived, was to have strategies that could go short. And obviously we look at all that for our alternative bucket to see where there might be opportunity. And then finally, emerging market stocks potentially could be an area to look at, because if the dollar is going down here in the US, the currency of your trading partner, whether it's emerging market or elsewhere, would likely be going up. And if you start with low or modest valuations now, coupled with a currency tailwind, then that could turn out to be a fairly beneficial situation. And then finally, there's one I didn't mention, but gold. There is a I would say a mixed track record on how gold performs during deflation versus inflationary time periods. But typically, if gold's working in a deflationary period, it just means that the currency of the country is coming under some severe stress. And with that, I just wanted to thank you for taking the time to join us today. Really appreciate the confidence you've got in our team, and we look forward to speaking with you at some point here in the near future. Thank you.